tonight, for the first time, not how to figure out what's a better or worse expected earnings report to do a good trade, seems to be a dominant way of thinking, but how to put these reports to work for you. Select the best stocks and prune those that need to go. Talking in a longer-term perspective. We figured out how to compute the growth rate of a company and whether it's too expensive based on that growth rate. Something at Jim Cramer on Twitter, I just keep getting that question. Now it's answered. We've explained the importance of sector analysis as part of the earnings report. And we've learned how to focus on gross margins, something that can only come out of the conference call. Now we must address two more pieces of the earnings puzzle, and these are really important: dividend growth and home run potential. From pretty much the time since I first bought stocks in the late 1980s until fairly recently, dividends were an afterthought, okay? Ever since I had my hedge fund. Companies became enamored of buybacks as a way to return money to existing shareholders. To me, it's oxymoronic, as you're only returning money to departing shareholders. You're making it easier for them to exit. The only real winners with shareholder buybacks, except in extreme cases, in AutoZone worked, and Novellus, okay, are the executives who get paid for hitting certain earnings-based targets. They do that by shrinking the float through buying back just enough stock to make it so when the share count is divided into the earnings per share, well, it beats the compensation benchmark that they were supposed to hit. Only a very handful of buybacks do what they're really supposed to do. That is make it so there are far fewer shares out there, something that can drive a stock higher if the earnings are really excellent. But the buyback that actually accomplishes that goal, man, I got to tell you, I count them on one hand, all right? Most buybacks have turned out to be a huge waste of money as companies have spent a gigantic amount of cash buying their stock when prices may have been appreciably higher because they don't know anything about stocks. They only know about their own business, which is fine. They should stop trying to time the market. What should they be doing? What are the good companies doing now? They are offering more and more bountiful dividends. Something is a much better sign that a management believes in the future than a buyback. Buybacks are indefinite, capable of being reined in sub rosa. Dividends are an out-loud declaration of long-term confidence. Now that low rates seem to be upon us for some time, courtesy of Fed anxious to store some gasoline on the smoldering economic embers, dividends can provide a rate of return that certificates of deposits that you keep trying to make money with can't. Of course, stocks present more risk than CDs. They can go down, but they can also go higher. And that's often the case with companies that continue to boost their dividends year after year. And if you reinvest those dividends, you can augment your return to the point where you are far exceeding a return on bonds. Dividends are so important. They've been responsible for almost 40% of the S&P 500's return in the last 10 years. They are also the main reason why the Dow Jones average, with its above-average dividend yield, far outperformed the S&P 500 in 2011. 5.5% return for capital appreciation. How about making a total of 8% if you reinvested the average's dividend? And the only thing you should really be thinking of when you talk about benchmarks is reinvested dividends. Cash in your pocket, a safety net during the bad times, and a trampoline in the good. So what do the earnings have to do with the dividend component that we so often seek on Mad Money? Simple. We listen for calls that tip management's hand on the dividend. They tell us there's enough excess cash available to boost that dividend, perhaps several times in a short period of time. Hey, that's what we heard from General Electric in 2011. That was signaled, well, it was on every conference call they mentioned it. Conversely, if a company signals the desire to buy back even more stock and the buyback's ineffective or reducing the share count by much, you got to look at how many shares it had in the year before, you should presume that the buyback is all about management enrichment until less proving innocent, okay? They're just seeking to contain the damage from the shares and options offered to management. A lot of tech companies do that. I've regarded as disgraceful. No one else thinks that. I don't care. I know what I see. These days, if a management doesn't indicate it might boost the dividend on the earnings call, you can count me out. Unless the company has such ferocious earnings power, a la Apple, that I'm willing to overlook such an indiscretion. We also need to listen for something breakout, something new on a conference call, something the company's going to do differently or is going to announce soon that can serve as an upcoming catalyst. I always talk about catalysts in the show. You need a catalyst to buy a stock. I scrutinize calls not so much for what has happened, that doesn't interest me, but something that will happen. And if I hear something that sounds like it could propel the stock in the future, I am anxious to buy it. And if there's a sell-off because someone's disappointed the company didn't beat the estimates by enough or didn't guide high enough to please the momentum funds in the stock, I got my opportunity. All right, so what are the examples I look for? Pharmaceutical companies, they often telegraph what might be going into stage 3, okay? Meaning what drugs might be near final approval. They often tell you about expanded usage on their labels for drugs. Allergan, one of the best performing drug companies over the multiple years, has told you more about the future on its call than just about any other. And it has been a terrific buy every time it sells off after earnings because of this upcoming catalyst. It constantly do it. By the way, Celgene, same thing. Okay, Celgene, they give you a call that tells you what's coming up. Tech companies often tip their hands about upcoming product cycles, product initiations that can make a huge difference in future earnings. Pipeline companies, key creators of dividend wealth that we talk about all the time, they tell you about upcoming expansions that could be additive to earnings. The exploration production companies almost always tell you what prospects they're looking for. And when you might hear some really good news on these calls, I always file those comments away and wait for the oil futures to go down. Then I can start buying the oils. Hey, that's what happened last year with Continental Resources, CLR. It gave me a bountiful chance to get in before it raised guidance from new finds later in the year. We had gone out to the Bakken. They were talking about how the storms had kept their drilling down, that the storms ended. Nobody cared. And then the stock took off when they told you that business is big and booming. The bottom line, we look for signals about the future in these calls, particularly about upcoming catalysts that will move the stocks later on, making them solid buys on any short-term decline because it wasn't better than expected. And we try to measure confidence about cash flow that can ultimately trigger rising dividends, the best source of wealth that stocks can give us. Remember, dividends pay us to wait for things to get better, and there is no better way to find out about the prospects for increased dividends than to listen in on the earnings calls. Stick with Cramer.